He made $100 million in a single autumn. While the country fell apart around him, while his neighbors lost everything, while the ticker tape piled up on the floor of the exchange like a confession nobody wanted to read. The question was never whether he saw it coming. The question is, how do you live with being right about something like that? Welcome to Tales from Wall Street. I'm your host, the Options Lizard. And tonight, we're not chasing hype. We're not selling dreams. We're studying behavior. Because behind every stock chart, every boom, every crash, there's a story. What you're about to hear is educational content about historical events. This is not financial advice. These are true stories with real consequences. The lessons are yours to learn. His name was Jesse Livermore, and by the time most people had ever heard of him, he had already been broke twice. Not merely unprofitable, broke. Margin called, humiliated, starting from zero, broke. Once in 1907, again in 1915. Each time he rebuilt from nothing through sheer force of observation and an almost inhuman capacity to sit still while being wrong. That history matters, because the man who read 1929 correctly was not a genius untouched by the market's cruelty. He was a man the market had already destroyed, who understood its mechanics from the inside of a wreck. By 1928, Livermore was worth millions and operating from a private trading suite in Manhattan, running what amounted to a one-man hedge fund before the term existed. He had no partners, no committee, no one to argue him out of a position. He traded on feel. But feel built from 20 years of scar tissue. And what he felt, watching the market in 1928, was something most professionals refused to name. The rally was too easy. The buyers were too confident. And underneath the euphoria, if you knew where to look, there was $8 billion in margin debt. Borrowed money propping up paper gains, waiting for a reason to unwind. Here's the thing about $8 billion in margin debt. It doesn't announce itself. It just sits there, patient, structural, invisible to anyone who doesn't want to see it. Livermore wanted to see it. And in early 1929, he started placing his bets. He started small, a short position here, a short position there, probing the market the way a doctor probes a bruise, looking for the spot where the pain is real. The market pushed back in early 1929. A sharp rally in March shook out every weak short on the street. Most of them covered their positions and walked away, thankful they escaped with their skin. Livermore covered too. Then he re-entered, larger, because the bounce had told him something the bulls didn't intend to broadcast. The market needed to be rescued. And markets that need rescuing are markets with something to hide. By summer of 1929, his short book was substantial, spread across the major industrials and rail stocks, the backbone of the American economy at the time. His wife, Dorothy, knew nothing of it. His social circle, men who were long this market with their entire net worth, knew nothing of it. He ran the operation in near total silence through a network of brokers who each saw only their piece of the puzzle. The Dow hit 381 on September 3rd, its highest point, the level it would not see again for 25 years. Somewhere in Manhattan, a man in a perfectly pressed suit was already short the entire thing. And he was not in a hurry. October 24th, 1929, Black Thursday. Nearly 13 million shares change hands in a single session. A number so large, the ticker tape falls hours behind, printing prices that are already ancient history by the time traders read them. On the floor of the New York Stock Exchange, men are shouting at numbers that no longer exist. The senior bankers move. Morgan, Chase, national city. They pool their resources and send a representative onto the floor, publicly, visibly, to purchase stocks at or above market price. A show of force, a signal. We are not afraid. The market steadies. By the close, the worst appears to have been absorbed. For one long weekend, America exhales. It was the last exhale for a very long time. Monday morning, October 28th. The banker pool does not appear. There is no coordinated buying, no signal of confidence, just silence. And then the Dow falls 13% in a single session. Every professional in New York understands what that silence means. The support structure is gone. Tuesday is worse, another 12%. The ticker tape is useless. Brokers stop answering phones. Margin calls go out by the thousands. Demands for cash that investors do not have, which forces liquidations, which drives prices lower, which triggers more margin calls. The machine is eating itself. In Livermore's offices, away from the floor, away from the screaming, the numbers are moving exactly as he said they would. His short positions, built across months of discipline and isolation and doubt, are printing money at a rate that has no modern reference point. Every point the Dow falls is his. Every margin call that forces a liquidation is his. Every investor who bought on margin with money they didn't have is, in a precise and terrible sense, paying him. He covers. Not all at once. Livermore is too careful for that. But through November, as the Dow slides toward 200, he closes the bulk of his positions. The final tally? Somewhere between $100 million and $130 million. In 1929 dollars. Roughly $1.7 billion today. Made in a matter of weeks. From a market that took decades to build. The newspapers find out. They always find out. And when they do, the framing is not "genius reads structural conditions correctly." The framing is "man profits while America burns." Which is true. Both things are true simultaneously. And that is the part that is hardest to sit with. The death threats came first, then the editorials, then the congressional whispers. Newspapers called him the man who broke the market, as if one man's short position had caused 13 million panicked investors to sell at once, as if margin debt and reckless lending and the decade of easy money had nothing to do with it. It is always easier to name a villain than to understand a system. His wife Dorothy, who had told nothing, who had watched their social circle disintegrate across dinner tables and charity events, not knowing her own husband was on the other side of every lost dollar, reportedly read about his profits in the newspaper. She had been living inside his secret without knowing it. He had conducted one of the greatest trades in financial history in complete silence, surrounded by people he had not warned and could not warn, because telling anyone was the same as losing the trade. For a short while, he was the richest speculator alive. $100 million. He bought a yacht. He bought a mansion in Great Neck. He maintained offices in Manhattan and lived the life of a man who had permanently solved the problem of money. He hadn't. By 1934, it was gone. Not slowly, violently. Bad investments in Florida real estate and commodity ventures, a disastrous divorce settlement that carved him open financially, and something harder to name. A psychological unraveling that his earlier biography had been predicting for years. The man who could hold a short position for 12 months through public ridicule and personal doubt could not hold his own wealth for 5 years in peacetime. The skills that built the fortune were not the skills that kept it. This is not an uncommon story. It is, in fact, the most common story. Bernard Baruch, who had also moved to safety before the crash, who had read the same signals, walked out of 1929 celebrated as wise, his reputation intact, his wealth preserved. The difference was not intelligence. It was temperament and discretion. Baruch understood that being right in public is expensive. Livermore had never learned to want anything other than to be right. Charles Mitchell, chairman of National City Bank, the loudest bull of the era, the man who had spent 1929 publicly dismissing concerns about margin debt and credit, was arrested in 1933 for tax evasion. Acquitted, but finished. The culture he had represented, the triumphalist certainty that the market only went up because American prosperity was permanent and structurally guaranteed, that culture did not survive the decade. And Livermore himself, November 28, 1940, 11 years after the greatest trade of his life, he walked into the cloakroom of the Sherry Netherland Hotel in Manhattan, sat down, and shot himself. He left a note that called his life a failure. $100 million, the greatest short in history. And 11 years later, a note that said, failure. Here is what Jesse Livermore understood that almost nobody else did. The market is not a voting machine. It is a weighing machine. And in 1929, the weight of $8 billion in margin debt was sitting on a scale that everyone had agreed, by some unspoken collective agreement, not to look at. Livermore looked. That was the whole trade. Not genius, not luck, just the willingness to see what was already there. The hard part was never the analysis. It was the year of being wrong on paper, while being right in your head. It was sitting short a market that kept going up, while your colleagues laughed, while your broker called, while the newspapers celebrated the dawn of permanent prosperity. Most people cannot hold a correct idea under that kind of pressure. The ones who can, those are the ones history remembers. And here is the darkest part. Livermore won the trade and lost the war. The $100 million did not save him. The psychological patterns that made him a great speculator, the obsession, the isolation, the willingness to go against everyone, those same patterns ate him alive when the market stopped cooperating. Michael Burry said something similar after 2008. He was right about everything, and it nearly destroyed him. Being correct at scale, against the crowd, at catastrophic cost to others, that is not a comfortable place to stand. Livermore stood there for 11 more years. Then he didn't. If this story made you think, you know what to do. Subscribe to Tales from Wall Street, hit the bell, leave a comment. Tell me which story you want next, because there are 1,000 more where this one came from. And I'll be here, waiting. I'm the Options Lizard. These have been Tales from Wall Street. The man who saw the crash coming never saw the one that was coming for him.